Hi, this is James from DigFin. Blockchain, what's it good for? Well, if we're talking about open, permissionless blockchains like Bitcoin or Ethereum, for financial services, it's early days. But when we're talking about private, permission, distributed ledgers, things are happening in finance and they're happening fast. My colleague Larissa just did a story on trade finance blockchains. You know, the problem is, how do you get everybody onto the system? Not everybody can integrate into a distributed ledger. So for example, she's reporting on how systems designed for bills of lading and other very niche things are being plugged into bank and corporates blockchains, so that trades get financed not in days, but in hours. That's the beauty of this technology. Forever, financial firms have invested in their own systems to achieve straight-through processing, or STP, but it's always been done at the level of the firm. Blockchain is STP at the level of the entire market. How you doing? It's now hitting the securities world. It began in the United States with DTCC, which processes virtually all of the securities in the US market. They began experimenting with blockchain for warehousing swaps, and that's been very successful. Then Australia Stock Exchange announced about 2 years ago that they were going to replace their post-infrastructure system with a blockchain-based solution. And now it's come to Hong Kong. Hong Kong Exchanges and Clearing is undergoing a project with the vendor Digital Asset, which also is a vendor to ASX and to DTCC, to what looks on the surface like a fairly modest proposal. They just want to use blockchain to support the northbound trades on Stock Connect, which is their program allowing fund managers based in Hong Kong to buy and sell Chinese A shares on Chinese domestic markets. The ASX solution was a great start by putting the custodians and some of the brokers on a blockchain where they could share the information in a secure way. What Hong Kong Exchange is doing is moving this into the realm of the middle office, and they're doing it through allocations. It's where after a transaction happens, the cash or securities that are being traded get doled out to all the different portfolios, the clients, for which the fund manager is representing when he or she executes that trade. It's technically a post-trade activity, but actually, because the client all have to be assured that they're all getting the same best execution pricing, and so there's no conflicts of interest, the fund manager actually has to decide who's going to get what from those portfolio trades before the transaction happens. So what we're seeing is, if allocations are brought onto a distributed ledger for processing, then this technology is now leaving the back office, it's entering the middle office, and all the way to decisions being made by portfolio managers. This, over time, will have a big impact on who gets paid for what. Now, if you want to stay on top of all the winners and losers in fintech, be sure to keep reading us at www.digfingroup.com. This past week, we had exclusives on Siam Commercial Bank, Cupital, and Block One. This coming week, I'm going to be in Singapore for the FinTech Festival. Larissa will be at Money 2020 Hangzhou. Drop us a line, ping us on LinkedIn, come find us. We'd love to meet you. In the meantime, thank you for watching. This is James from DigFin.